At this time, I'd like to introduce our keynote speaker, Dr. Arun Raha. Arun Raha is Chief Economist for the State of Washington and Executive Director of the Economic and Revenue Forecast Council. He is responsible for preparation and presentation of quarterly forecasts of Washington's economy and the general fund revenues. He also advises state legislative committees and other government agencies regarding economic and revenue activity in the state. Dr. Raha was formerly Vice President, Economic Research at Swiss Re in New York, a leading global reinsurer headquartered in Zurich, Switzerland. There he was responsible for forecasts of North American microeconomic, financial, and property casualty insurance markets. Prior to that, he was manager of economic analysis at Eaton Corporation, a global diversified industrial manufacturer in Cleveland, Ohio. Please help me welcome Dr. Arun Raha.
Good afternoon. It's good to be back here in the Tri-Cities, the shining center of economic prosperity in the state. And it's great to see an expo such as this, because after you hear what I'm going to tell you, you may want to give yourselves a pat on the back, because this is exactly the kind of activity we need to get the recovery going. So anyway, usually I'm glad to be anywhere but in Olympia, because, you know, my job, I mean, in case chief economist of the state, it doesn't mean anything. Nobody knows what I do. No, really, nobody knows, not even myself sometimes. But here's what I do. I poke my head out of my hole in Olympia 4 times a year, and I pronounce a number. Oh, wait, before that, I look if I can see my shadow. If I can see my shadow, then that's 2 more years of budget cuts. But anyway, one of the first rules of forecasting that I learned years ago was forecast often. That way you can't be wrong. You can keep changing your forecast. Because think about this, you know, people expect you to make a forecast, and then 2 years later, the world has changed, but they expect that forecast still to come true. I'm a forecaster, not a psychic. You know, so at some point, I have to change my forecast as conditions change. So conditions changed, and I forecasted in September that, you know, what I told the government they had in expected revenues for the rest of the biennium was going to be $1.4 billion less than what I told them in June. So you can imagine they were all upset. It's not a trivial amount of money, and so it is reasonable to ask me, Arun, you idiot, what is it that you knew in September that you didn't know in June? What is it that's so much worse? Were your revenues coming in way below forecast? No. Our revenues actually came in only $40 million below forecast since June. Just 40 million out of the 3 billion or so we expected to collect in those 3 months. That's 1.2% from target. Now, you know, economists, 1.2% from target is considered a perfect hit. In fact, plus or minus 2.5% from target is considered a perfect hit. It's a probabilistic world. Things can happen. So it wasn't the revenue shortfall. It was the changed economic circumstances. It was the changed outlook. And let me break it down into different pieces. But before I do that, I'm going to talk about the global economy. I'm going to talk about the U.S. economy. I'm going to talk about the state economy. And then finally, I'm going to boil it down to what it might mean for you here in the Tri-Cities. So we are not immune to things that are happening around the world and in the rest of the nation. So here's the first thing that happened. And it was a traumatic event for me. I remember the date very well. It was the 29th of July when they revised GDP on us. They revised it all the way back to 2003. GDP is gross domestic product. It's a measure of the level of economic activity in the nation. And when we forecasted in June, the GDP we had was the broken blue line, the dashed blue line. And when we forecasted in September, they had revised it after the June forecast on the 29th of July. So in September, we knew that it was the green line that was the revised numbers for GDP. Now, here's one thing that nobody, excuse me. I feel like a sneeze coming on, but I'm going to try and control it. Okay, hold on. Okay, so here we go. I managed to, oh, wait, victory. Okay, so here we go. So in June, we had a first half of the year that had economic momentum being held back by short-term factors, such as the supply chain disruptions in Japan. And Japan's an important part of our smartphone and our smart chips and our automotive supply chain. And we had short-term effects like the rise in the price of energy because of the unrest in Libya. Another thing that you notice here, which is very significant for economists, is that if you're an accountant and you go back and you change your numbers, you probably get sent to jail. If you're an economist, you go back and you change your numbers, it's okay. So that's a great benefit to being an economist. But it makes our life difficult every once in a while. So when I came out to forecast in September, instead of an economy that had momentum held back by short-term factors, I saw an economy, and if you look at it carefully, it's stalling out in the first half of the year. Growth in the first quarter was 0.4%. Growth in the second quarter was 1.3%. So now we have an economy at stall speed. And even if those temporary factors holding it back were removed, the best we could hope for is sideways movement. I've always talked about this recession being a U-shaped recession. U as opposed to a V, which meant we'd be down in the trough for a while. But, you know, I'm not allowed to think beyond the end of the biennium. So I only see the world ending on June 30th of 2013. I can't think beyond that. So now what has happened is that EU, you know, the part where it's supposed to go up, I can't see that anymore. So now I have learned a new letter of the alphabet. It's called L. So now we have come down. We're moving sideways. The best we can hope for is this continued muddle-through scenario. I call this muddle-through, which is weak growth, high unemployment, weak confidence, and slow job growth. The worst we can hope we might get is we might get another recession. And some people have already predicted that we will be in another recession. Now, I'm not that dour. I don't think we're in a recession. I think there's an increased possibility of recession, but I don't know if we'll get into recession. I'll go into some of the factors. Now, remember, I'm talking at many different levels. The global economy, the world, the U.S. economy, the state economy, and then, of course, your local economy. The U.S. could go into recession, and it may not matter for you, like it didn't in the last recession. And it may matter more, who knows? We'll find out. Here's consumer confidence. What happened to consumer confidence during this recession? It fell to the floor, it came up, and it tread water for a while. And I'm sure this is not representative of consumer confidence in the Tri-Cities. So this is U.S. Fellow looked around for direction for a while and then tanked again. It never got out of recessionary territory. It has been really tough out there in the rest of the country. And you know why people are so distressed? When you look at consumer confidence, 50% of the movement in consumer confidence can be explained by the unemployment rate. So if the unemployment rate is so high, that's why consumer confidence is so weak. And then another 25% can be explained by the price of gas. So 75%, 3/4, can be explained by just two things, the unemployment rate and the price of gas. And here's what we have. The part where it starts to tank again has nothing to do with unemployment or the price of gas, because I looked at that period, unemployment was pretty stable, high but stable, it didn't change, and the price of gas actually eased. So if anything, confidence should have gone up, but it fell. So I looked at a different tracking poll that Gallup did on every day that we had this debt limit debate in Congress. And during that debt limit debate, consumer confidence collapsed steadily. So what you're seeing there is a reflection of people recognizing that there is political gridlock in our nation's capital. And you know, I am nonpartisan, so I'm not blaming either side for it. No, actually, I'm bipartisan. I'm blaming both sides for it. And also, let me be clear, all the criticism you hear from me of the federal government, I am a state government employee. I have to assure you that your state government is totally perfect in every way. So no criticism of the state government. But here's the problem. We, as consumers, you know, we have monetary policy and we have fiscal policy. These are things government can do to help the economy out of a rut or to protect it from, you know, the vagaries of the business cycle. Because there is a business cycle, and this time we fell hard, and we fell really hard. It was the worst recession since the Great Depression. And monetary policy is pretty clear. It's going to be easy, cheap money for a long time, which is great if you have an adjustable rate mortgage, or if you're looking to buy a house. Oh, by the way, if you would, you know, it would help our state revenues a lot. So if you can, go get a loan and buy a house. That's my first ask. I'll ask you for more later. But monetary policy by itself cannot get the economy moving. At this point, monetary policy, you talk to any economist, is like pushing on a string. It doesn't get anything done. The Fed has put all the money out there. It's not going to work unless it gets spent. It won't get spent if there's no confidence. And it won't get spent if there's no fiscal policy. And I'm not asking for a specific fiscal policy. I'm not saying it ought to be a spending increase. I'm not saying it ought to be a tax cut. That's a political decision. I'm not saying it ought to be a clarification of regulations. That's a political decision. But it has to be something. Monetary policy by itself, and without fiscal policy helping it, cannot get us out. So in my forecast and in my outlook, I have completely discounted anything coming from Washington, D.C. to the state until at least the next elections are passed. So that's been discounted, and it looks like consumers also are of the same mindset. That's why they're losing hope. And that perhaps is a misfortune. But, you know, things within the United States will get better. And I'll come to that in a minute. It eventually always does. But what has happened, it's not just dropped consumer confidence. This is business confidence. This is small business optimism and sales expectation. Look at how that has gone down. And you'll notice this pattern with everything, with GDP, with consumer confidence, and I'll show you a few more, but with business optimism and with small business sales expectations, they dropped, they came back up, and then it's almost like the recovery lost steam. And that pattern, that V-shaped pattern, and then the drop-off, you'll see in slide after slide after slide. You can draw your own conclusions from it. Okay, so consumers are scared, businesses are scared, and financial markets are scared. That is the VIX index, which is an index of volatility in the markets. It's an index of fear, how much fear is out there in financial markets. It's a proxy measure for the amount of fear. We're not financial meltdown scared. We're not Lehman 2008 scared. But we're definitely more scared than the Greek crisis a year ago. Financial markets are very nervous. If you read the papers, see what they do. Every morning you get up and, you know, when I look at the stock market and I see which way it's going, I know whether Angela Merkel said the right thing today or not. If she says the right thing, it goes up. If Sarkozy says the wrong thing, it goes down. So that's what's become of our equity markets. They move around because of what's going on in Europe. And I'll come to that in a second. But here's why I think the U.S. is not in a recession. This is the Institute of Supply Management Purchasing Managers Index. Now that's a mouthful. But what it stands for is supply chain managers are surveyed every month by this institute. And and I'm not going to go into how this index is calculated, but the supply chain managers have a very good idea about what their company is about to do, because they have to order the parts, they have to order the papers and the pens and whatever it is you're producing, they have to order it in advance. So they are a leading indicator of what activity is going to be. And we don't get GDP until, is it this Thursday? We don't get third quarter GDP until later this week. So we look at tea leaves, and the Institute of Supply Management Index is one of them. And the rule is, if it's above 50, it means that sector is growing. If it's below 50, it means that sector is shrinking. So here too, look at what happened. The gray part, of course, by now you figured out that stands for the recession. During the recession, activity contracted in both manufacturing and services. Then we came back out. Now we're down, but we're still above 50. What does that mean? We're growing, but at a slower rate. That's not bad. We're still growing, but at a slower rate. It's a very fragile recovery. We've been growing at a very slow rate. Now here's growth around the world and in China and India. And the pie shows the share of world GDP in each of these economies. And the biggest pie, of course, slice of the pie is others, and I'm not going to worry about who all the others are, all the other countries in the world. But look at the US, Eurozone, UK, Japan, China, and India. So we hear China and India are growing fast, and they will pull us out of this recession. No, they will not. They're only 12% of the world's economy. That's the first thing to notice. Look at the pie on the left. They're only 12% of the world's economy. They're growing fast. China's growth right now, believe it or not, slowed down to its slowest in 3 years, and it was 9.1%. I wish we could slow down to 9.1%. Both China and India are seeing wage push inflation. Unlike us, they have a problem, they have a shortage of labor. It's driving up their wages. It's driving up their costs. And so the governments over there, to prevent their economies from overheating, are coming down, trying to slow growth and engineer a soft landing. So they're only 12% of the world's economy, plus their growth rate is going to be slowing. So they can't help us. Europe is about a fifth of the world's economy, and Europe, even if we don't go into recession, I am pretty sure Europe will end up there. Europe will end up in a recession. Look at the expectation of the consensus forecasters, which is the top 50 forecasters in the nation, and doesn't include me, so it's not biased. This is their expectation of future growth. And look at the growth in the developed world. Next year, they do not expect growth to exceed 3%. Below 3%, global growth is considered a global recession. Below 3%, global growth is considered a global recession. So we are staring basically at a year, coming year, of uncertainty and slow growth. Now that's the reason, of course, I reduced my forecast. But here's my great explanation of why Europe is causing this problem. So this shows basically the exposure of U.S. banks to both sovereign and private debt in the PIGS countries, which is Portugal, Ireland, Italy, Greece, and Spain. Does that spell PIGS? Yes. And then France and Germany, because those are the largest two economies in the world. Now, and it shows the direct exposure of U.S. banks to both sovereign and private debt in these countries. The first column where it says SOV is sovereign debt, and the second one is private debt. Private debt could be to banks, could be to corporations, could be any. Now here's the problem. How much is our exposure to Greece? Only $1.9 billion to Greece's sovereign debt. So if they defaulted, big deal. But do you know, every morning people wake up worrying about, do I think Greece will default on its debt today? I mean, what a world we live in. Greece's economy is the size of Washington state, and yet it has this profound impact on the global economy. It's by spreading fear, panic, and uncertainty. How? If Greece defaults, and I'll go to the next page and I'll show you who else is in risk of default, Ireland and Italy, and we'll get there. It's like a domino. If they start defaulting, what happens? French and German banks, which you see in the second layer, they have a tremendous exposure to this sovereign debt. They will take a hit, a major hit. And so what is starting out as a sovereign debt crisis will turn into a European banking crisis. Unless, never saw a one-armed economist, did you? On the other hand, unless they are able to build a firewall around European banks so that even if they take the debt losses, they are still capitalized well enough to survive and function and make good on their obligations. Their obligations to U.S. banks. That's where the U.S. is vulnerable. If the sovereign debt crisis in Europe turns into a European banking crisis, and that will then make it a U.S. banking crisis. And you know, the problem with this banking crisis since Lehman that we found out is no one knows where it'll end, you know, who's going to take what loss. So for a while, you will see credit markets dry up, you will see economic activity start to slow down or stop, and then all bets are off, because we'll go into recession, definitely. But here's how much exposure we have. If you add up all the sovereign and private exposure that U.S. banks have to these 5 countries and to France and Germany, it's $663 billion. That's the direct exposure to sovereign and private debt in these countries. The indirect exposure through credit derivatives, through loan guarantees, and through other financial instruments is $1.3 trillion. So if you add that up, our net value at risk for our banks is not just the 1.9 billion Greek sovereign debt, it's more than $2 trillion that are at risk out there, which is why our markets are so nervous. They're nervous about what goes on in Europe. Europe is driving U.S. equity markets. Every day you get up and see what's happened, it's Europe. And that's the problem. Our economy is growing. The U.S. economy is growing. It's in muddle through, but it's growing. It's not falling. But if Europe falls, it can drag us down. It remains to be seen if they will or not. My baseline says they won't drag us down. I'm an optimist. Okay, so who's at risk of going down? On the first side, you see gross government debt as a percentage of GDP. On the second side, you see budget deficit as a share of GDP. Now, debt and deficit are not the same thing. They're related. The debt is the sum of past deficits. So every year you add the amount of deficit to your debt. That's what happens. Now, Greece, people think, is almost entirely certain to default because its debt to GDP is so high and its deficit to GDP is so high, so they have no ability to repay. So they will default. Now, the question becomes, will Europe be able to make the German and the French banks whole so that our banks, US banks, are safe? Italy also looks like it's about to default, although its deficit to GDP is small, so it may be able to run up a bigger deficit to pay off its debt. Ireland has debt to deficit close to 100%, but it's debt to GDP close to 100%, but deficit to GDP is almost a third. So they have no ability to grow that deficit to pay the debt. So these are the three countries at risk. And then once the dominoes start falling and who knows who takes what losses, who knows what will happen. You know, there's an old Chinese curse, I think, which says, may you live in interesting times. And we are. Okay, that's the slope of the yield curve. It's the spread on the yield curve. It's the long-term interest rates minus short-term interest rates. And it usually is a very good indicator of what growth is likely to be based upon what the bond market expects. It's the difference between the 10-year Treasury yield and the 3-month Treasury yield. And here's this nice thing you'll notice. Every once in a while, the number becomes negative. And so you'd notice I have those segments in red. And notice what happens after each time it turns negative, which when it's negative, we say the yield curve is inverted. Every time the yield curve inverts, it leads to a recession. So it doesn't take a genius to figure this out. Which is why economists are good at this thing. So we look at this, and you know, every time it inverts, we go running to our boss and say, there's a recession coming, and it turns out to be true, and they think, wow, what a good forecaster. But look at where it is now. It is still positive, but moving down. What that means is it is showing, bond market behavior is showing that they expect weaker growth, but not a recession. Not yet. So again, I'll say, there are some people who think we are in a recession. I think the risk of recession is higher, but we're not in a recession. Isn't that cheerful? That's cars. I'm not worried about cars. I look at car sales because car sales are 5% of our state revenue. Depth of the recession, we were at 9 million annualized per month in the nation. And Washington follows the same pattern. That's the red line. The blue bars are the nation, Washington's the red line, and it's the scale on the right. We're now back up to about 13 million And that little tapering off that you see is a consequence of the Japanese disaster. It's not a shortage of demand, it's a shortage of supply. Because there was not enough cars, prices went up, so people reduced their buying. Otherwise, we'll get back to what the 16 to 17 million normal over time. What we have here is, I don't have the slides here to prove it, but if you want to come down to my office in Olympia, I'll show it to you. We are driving around in the oldest cars ever. Let me repeat that. We are driving around in the oldest cars ever. That's un-American. It cannot be sustained. It cannot be sustained. I'm not worried. I'm not worried about people buying cars. They will. Yeah, think of that new car smell, you know, you'll just go crazy. And all the incentives are going to get loaded on, you know, as the Japanese manufacturers get their production going. So, yeah, you'll probably just have to buy a car. By the way, that's my second ask. Go buy a car if your car is old, you know. Okay, so here's what's slowing down revenue. Construction is between 4 and 5% of this state's economy, but it's between 8 and 10% of this state's revenue base. Construction is taxed more heavily than other sectors. This is non-residential construction contracts in the state of Washington. The good news is the rate of decline is slowing. Look at the bars, they're getting shorter. And even better news is that little light blue bar, which is there by itself, so you know it's different, is year-to-date 2011. Earlier in the year, that bar was longer and deeper. So if year-over-year, this is year-over-year change, year-to-date gets smaller and smaller and smaller as the year progresses, what that tells me is that month to month, things are getting better. So non-residential or commercial construction, it's at half of what it used to be, but it's hit bottom, it's coming back out. Not every sector, not every part of it, but it is coming out. So that's good news. This is residential construction. The green line is single-family building permits in the state. That's about a quarter of where it was, and it's bumping along the bottom. And I'll talk about when we can expect recovery there. But look at the blue line, which is multifamily apartments, which is was bumping along the bottom, hit bottom, but even through all that noise, you can see the clear positive trend. What's going on here? You know, at the early part of the recession, when our kids got out of college, they moved back in. That didn't work out too well. They've been kicked out now. So now they're graduating and going and occupying Wall Street. But eventually, they will have to come and look for space to live in. And they're not going to buy a house because their credit is shot and they don't have a job. So they have to live in an apartment. And so rental vacancies are going down. Rents are stabilizing, and banks are making loans for multifamily apartments. So that is why you're seeing that strengthening. And I bet if you look in other states as well, you will see that strengthening in multifamily apartments. The one point I do want to make is that Washington rental vacancy rates are lower than the national average. They are lower and significantly lower than the national average. So we are actually better off in terms of the multifamily recovery. Now, what will bring a single-family recovery to happen? This is home prices, and you can see they're still declining to soft. This is Seattle home price. I don't know what happened here. I believe home prices didn't decline very much over here. The real estate market stayed strong here. But in the rest of the country and in Seattle, you're still seeing declining home prices. And ultimately, for the overall housing market to recover, what you need to have happen is you need to see home prices start to rise. Why? First of all those people who are trying to time the bottom of the market, let me tell you, it doesn't work. This is a good time to buy. Interest rates are low. If you have the credit, get it. Buy a house. You're trying to time the market, you only see it in your rear view mirror. Whoops, I missed it. And then it's too late. The second reason why home prices need to turn around is that banks find it easier to make a loan against appreciating collateral. If the collateral is depreciating, even though interest rates are low, their underwriting standards are very tough. So you can't get a loan. So how long will it take home prices to start moving up? The reason they're soft right now is because of what we call the shadow inventory of foreclosed homes. And what I've done here is I've got a chart of the percentage of mortgages that are seriously delinquent, which includes 90 days past due or in foreclosure. And the reason I added them up is because the rate of foreclosure depends upon a lot of administrative things. But what I'm looking at here is the housing stock at risk of foreclosure. And what rate they'll be foreclosed on, I can't really say. But my best guess is that here, notice something, our rate has leveled out, the national rate is coming down, but it's still higher than ours, and we're about middle of the pack. We're 23rd in the nation. So I don't expect any immediate relief in home prices because of this shadow inventory of foreclosed homes. But look at 30 days past due. You realize it's mathematically impossible to be 90 days past due without first being 30 days past due. Right? So 30 days past due, we are 47th in the nation. So our foreclosure pipeline is drying up. It'll dry up faster than the rest of the nation. So we'll get through this in 12 months to a year. 12 months to a year, that's the same thing. 12 to 18 months. I should tell you how I got this job if I have time. They gave me a math test. And they asked me, what's 7 times 3? I said, aha, I know that, 19. Pretty confident. I got in my car and was driving back to SeaTac to catch my plane back to New York when I realized, oops, I made a mistake. So I called them back, the contact number, and I said, can I change my answer? Is it too late? They said, don't worry, you got the job. You came closest. All right, so remember that construction will recover faster in our state than in other states. Okay, so if you look at our state economy, what is it comprised of? Aerospace, look at Boeing's backlog. 7 to 8 years of planes in its backlog. They're hiring more people than they can throw a stick at. They've hired back 2,000 people more than they laid off. Software publishing, doing fine. They've raised their compensation package. They've hired back the same number of people that they'd laid off. Employment is growing. We expect it to keep growing. We expect it to stabilize. Okay, so 2 of our largest industries are doing fine. Exports, we are the nation's most export-intensive state per capita. In the second quarter, even with our 3rd largest trade partner not being in a position to receive many of our exports, that's Japan, total exports grew by 31.5% over last year. And exports excluding transportation equipment, which means excluding those planes, half of which is agriculture, grew by over 40%. As populations in Asia get richer, they can afford to eat our apples and our cherries. And, of course, if the wheat crop is destroyed elsewhere, then our wheat farmers also do well. So look at Washington's economy. Boeing is doing fine. Microsoft is doing fine. Amazon's doing okay, even though their earnings results yesterday disappointed, but they're doing okay. Exports are doing fine. The only sector within the state that's not doing well, and that also affects revenue, is construction. And that's going to come out sooner than everybody else's. So what is wrong then? Construction and jobs. Job growth has been slow. You know why? Because 1/3 of the jobs lost in this recession in our state were construction jobs. That's the sector not coming back. Everything else is growing, but we're still 140,000 plus jobs in the hole from where we fell off. And we're not going to recover these jobs by the end of the biennium. I mean, I looked at the forecast. By the end of the biennium, we don't get back to zero because those construction jobs will be tough to come back, will be slow to come back. But here's the thing. Because of our high growth industries, because of our export intensity, because of Boeing and Microsoft and all of that, our job growth will be faster than the nation's. If that is any consolation. The national economy sucks, but here's my slogan for the state of Washington. We suck less than you. And we'll grow faster. We'll go faster even in personal income growth because, hey, we're just richer than the rest of the nation. So there you go. We suck less than you there too. That's revenue. I really don't want to show you this stuff because you don't care, but the point is by fiscal 13, we will still not be back to where we were in fiscal 8. I used to think we'll get back by fiscal 13, but I don't anymore. And here's the even scarier part. Revenues can grow because of 2 reasons. 1, inflation. 2, population growth. Even if everybody bought the same thing, right? So I control for inflation and I control for population growth, and I look at per capita general fund revenues. And here's what I find. If you leave out the recession years, where we'll be in 2013 is going to be where we were in fiscal 1993, that far back. So there's been a complete reset in what we're getting in revenues. So here's the thing, though. Before you go home all depressed and disturbed, first of all, I'm never serious about what I say, so don't believe me. Second of all, a recession is usually a time for people to rethink their business processes, to find efficiencies, to find new customer demands. You know, I heard this, I don't know if it's true, but 50% of the Fortune 500 companies were established during a recession. I know that it's true for Boeing, back in 1910, was established during a recession. I know that Starbucks was established during a recession. I know that Microsoft was established during a recession. So I think a recession is a time for renewal. It's not a time to give up hope. We've been through worse, and we'll get out of it. The Great Depression was 16 years. This will be 5 years, maybe 6. I don't know. Depends on Europe. But we'll get out. And we'll get out to a better future. So you can't give up hope. So things like this Expo, and this room full of people interested in doing business really gladdens my heart. Because this is what we need more of. Thank you very much.
free book.
There's no water here.
Hey.
You understand that?
You better get in the
Get you guys in there.
Oh, that's a good crunch right there.